Morgan Stanley released their list of 30 stocks for 2025, which isn't the right number. You're supposed to have 25 for 2025. But they've got a list of 30 stocks that's fare highly on what they call quality metrics, which roughly means make a lot of profit relative to the amount of assets that they have. And they found a lot of these in what you would consider to be ordinarily unpromising sectors. So I'll give you a clue here that none of the top 3 is a tech stock, which normally you would think fairly asset light, fairly profits heavy, at least when they're making any profits, that is. So, Steve, number 3 was a company called Old Dominion Freight Line, which is a trucking company, by the way, that I don't think you, me, Paul, or Casper owns. I don't know Casper's portfolio that well, but I don't think he owns it. Sorry if I'm wrong about that, Casper, and anyone listening. Number 2 is a stock that Paul owns and Casper might own, and I don't think you or I do, which is JP Morgan, which is an interesting one to see in a kind of high return on assets thing, but there you are. Number 1, top of the list, best stock for 2025 for people looking for quality companies, is one that you own. I don't think Paul owns it. I'm not certain about that. I definitely don't own it. And Casper, I'm 50-50. I would say, if I was pushed, I would say he probably does own it. Any ideas what it is?
I'm guessing it's a REIT of some description.
Yup. What REITs do you own, Steve? You better own this, or I'm going to have to redo this section.
I'm going to go with Prologis.
You're going to be correct, Steve. Well done. Yes, Prologis is indeed Morgan Stanley's number 1 stock for 2025, according to their kind of quality metric analysis. So they pointed out quite a few things that I like about this, and this kind of plugs into my thoughts about Segro a little bit to bring us back there, because I sort of think of it as maybe like a UK Prologis, but not quite the same thing. So here are some things they quite like about it. The average lease on a Prologis warehouse / industrial distribution centre, sort of long expression for warehouse, is about 7 years, and they generally have this interesting kind of fixed approach. So they're not strictly triple net lease, but they are quite similar, I think. They have what they call a clear lease thing that we might come back to another time. And rents are going up in this sector, points out Morgan Stanley, which is good. They think that inflation might be helpful to Prologis to an extent, because they can partly pass through their kind of costs of power and so on, and that kind of thing. But it also makes these things, firstly, these things are really expensive to build anyway. Secondly, with prices rising and material prices rising in particular, they're really, really expensive to build for competitors. And they also note that Prologis has a thing that I always look for in a real estate moat and don't always manage to identify terribly well, which is why I stay away from a lot of real estate stocks. They have stuff in very, very good locations. And I kind of wonder a lot of the time, if you are a REIT, how do you differentiate yourself? What is better about Prologis' warehouse or Segro's warehouses compared to anybody else's warehouses? I assume they're all pretty much of a muchness. The only thing, as far as I can tell, and that means that switching costs are going to be fairly minimal in a few cases, but one of the things that can really make them stand out is ours are in a really good location, and the Morgan Stanley guys point out in nice, straightforward, simple English that people like me can understand that this really matters, because if you're busy trying to distribute stuff, you want to be driving it as little distance as you possibly can. So moving to a warehouse that is further away becomes enormously more expensive for you. You end up burning a lot more fuel. You end up using a lot more manpower to get these things to places, which makes everything more expensive for you. And if you have land and there's not an awful lot of it in the kind of good places to have warehouses, this is something that your competitors can't easily copy by, even if they do have the kind of capital, right, to set up a massive, great distribution centre of their own. This is something that protects them pretty well. Steve, you must be fairly pleased as a Prologis shareholder.
Yeah, I mean, this is a stock that I think I've banged the drum on this one probably for as long as we've been talking to each other. It's one of the REITs that I've always really liked. I just pulled up the fact sheet on Prologis and I've got sellotape to my notes, and founded in 1983, Steve. They're the number 2 in solar for REITs as well. So I wonder what kind of costs they've really got in terms of energy or inflation or heating to pass on. But 1.2 billion square feet on 4 continents is kind of crazy. And I was just looking at this analyst report here. They're calling it an irreplaceable portfolio of over 1 billion square feet located in the world's most vibrant centres of commerce, which is all you ever really want for a warehouse. I always think warehouses are one of the last things that a company really wants to get rid of, because it's kind of a sign that you're reducing in size, or you're reducing in the amount the lines of items that you sell. It's one of those cost cutting things that I think people are doing through gritted teeth. I think Amazon is different because Amazon just built and built. But I think, if somebody like a Next or somebody was starting to close warehouses down and not reopen others, then that's a slightly different kind of outfit. But Prologis has been one of my favourites for a really long time, and for all of the reasons that I like any REITs. I've got a set list of things that I look for in a REIT, and it's basically like, are they looking after themselves in times of debt? Do they have really good clients? What's their rent collection like? How moaty do I think the actual product is? And with Prologis, it's just like a tick, 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 tick. And it obviously means that, because you can see it's one of the biggest REITs in the world, so you don't get there by chance. This is a company that has really performed for a long period of time. I mean, look at these top 10 customers, Steve. It's Amazon, FedEx, DHL, UPS, DSV, Home Depot, Geodis, I don't know that one, Seva Logistics, and Molomask, the shipping company. So some very, very big shipping, postal, logistics companies there, the sort of companies that you want in your warehouses.
Yeah, growth is always hard for REITs in general. I mean, there's always a structural headwind for that, right? I mean, if you had to dividend out all of your income, you will find it harder to do things that will kind of make acquisitions and grow. You'll have a choice of either issuing shares, which is not ideal, or issuing debt, which is not ideal. But Prologis, and maybe it's true of the industrial warehouses in general. I mean, the stuff that I was reading from the report did indicate this was a general tailwind. We're indicating that, look, prices can go up in this fairly well without people switching and looking to move elsewhere. Industrial real estate still seems to be at a premium. Amazon, of course, did build, and that raises, I guess, questions around kind of overpopulation, but they don't seem to be happening just yet. Rents appear to be staying pretty strong. And just lately with this stock and with Segro getting whacked by rising interest rates, not the same ones, obviously, Segro being UK ones and Prologis being US ones, that's chipping away at the value of the market value, I guess, of their assets. Unless the REIT in question is something like CoreCivic or Geo Group, which I think are not REITs anymore, but you get the idea, they're real estate stocks. I'm not sure that asset value matters terribly. I mean, the reason it matters for them quite a lot is that they're in the business of trying to liquidate themselves, I think, because their prisons, and Biden's administration said, we're not renewing contracts with for-profit prisons. So the rough story from that went, okay, they said, fair enough, where are you going to put all these people? And they said, well, we'll buy the prisons off you. And they said, fine. It turns out they're really expensive to sell to the government. So that will cost you an awful lot, and therefore you should probably care about the kind of asset value of the things if your investment thesis is, yeah, we're going to sell them all for more than the market cap. And that's probably not a bad thesis where their market caps went. But if it's something like Prologis where you think, well, what we're going to do here is keep hold of these things, rent them out and charge people rent on them, I'm not sure you should care much about what happens to the kind of market value of the assets that you have. Your plan probably isn't to try and sell them in the near term. It's to keep them, basically.
Yeah, just to put some numbers to that, really, of just how important Prologis is to a lot of customers. I got some in my notes, just stuck to the top. $2.7 trillion is the economic value of goods that flow through a Prologis distribution centre each year. So that's 2.8% of the world's GDP. It's actually 4% of the 19 countries that they work in, 4% of GDP for the 19 countries that they're actually in. But 36% of all goods that are consumed in the US are shipped from a Prologis warehouse. That's crazy.
Yep, and if you think consumption is going up in the US, which it almost certainly is, I think, that's got to be a kind of nice tailwind for Prologis specifically, I suppose, as a kind of toll booth on these sorts of things.
Yeah, but it's the same, isn't it? It's that when America does get saturated, then Prologis has 18 other countries that they're currently in that will not be saturated, and a whole world beyond that will be catching up at a rapid pace.